Losses loom larger than gains. This quote emphasizes the phenomenon of loss aversion, where people feel the pain of losses more intensely than the pleasure of equivalent gains. The stock market is a complex system that no one fully understands. Kahneman acknowledges the intricate nature of the stock market, implying that predicting its movements with certainty is challenging. Overconfidence is a significant driver of financial decision-making. This quote highlights the tendency of individuals to overestimate their abilities and knowledge when making financial decisions. Investors tend to focus on short-term performance. This quote suggests that investors often prioritize immediate results, potentially neglecting long-term strategies and objectives. Confirmation bias leads investors to seek information that supports their beliefs. Kahneman points out that investors have a tendency to favor information that confirms their pre-existing beliefs, potentially leading to biased decisions. Diversification is a crucial strategy for managing investment risk. This quote underscores the importance of diversifying investment portfolios to mitigate risk and avoid overexposure to a single asset or market. Market trends often emerge only in hindsight. Kahneman implies that identifying market trends in real time is challenging, and they often become apparent only when looking back on historical data. Emotions can heavily influence investment decisions. This quote suggests that emotions, such as fear and greed, can impact investment choices and potentially lead to irrational decision-making. Herd mentality can drive market bubbles and crashes. This quote highlights the tendency of individuals to follow the actions of the crowd, contributing to the formation of market bubbles and subsequent crashes. Understanding one's risk tolerance is crucial for successful investing. Kahneman stresses the importance of assessing and comprehending one's risk tolerance to make appropriate investment decisions aligned with personal preferences. Investors often mistake luck for skill in investment outcomes. This quote cautions against attributing investment success or failure solely to skill. Random factors, luck, and market fluctuations can have a significant impact on investment outcomes. It is important for investors to assess the role of luck objectively and avoid overestimating their abilities based on short-term results. The illusion of skill is more prevalent in bull markets. This quote highlights how bull markets, characterized by rising prices and positive sentiment, can give investors a false sense of skill. During such periods, many investments may appear successful due to overall market trends, leading individuals to believe they possess superior abilities when, in reality, their success might be largely driven by external factors. Availability bias leads investors to overestimate the likelihood of recent events. This quote addresses the tendency of individuals to rely on readily available information or recent events when making investment decisions. This bias can lead to an overestimation of the likelihood of similar events occurring in the future, potentially distorting risk assessments and leading to suboptimal investment choices. Investors should focus on the process rather than outcome. This quote emphasizes the importance of focusing on the quality of decision-making processes, rather than being solely fixated on short-term investment outcomes. By focusing on sound investment processes that consider relevant information and risk management, Investors increase their chances of making prudent decisions, regardless of immediate results. Regret aversion can hinder rational investment decisions. This quote highlights regret aversion, where individuals avoid making decisions that could potentially lead to regret in the future. In finance, this can manifest as avoiding necessary portfolio adjustments or taking on less risk, even if it aligns with long-term goals. It is important to make investment decisions based on rational analysis rather than being solely driven by the fear of regret. Investors tend to anchor their decisions to irrelevant information. This quote refers to anchoring bias, where individuals rely heavily on the first piece of information encountered when making decisions. In finance, this can lead investors to anchor their valuations or expectations to irrelevant or arbitrary numbers, potentially distorting their assessment of investment opportunities. Investors often overreact to new information, leading to market inefficiencies. This quote highlights how investors can overreact to new information, causing exaggerated market movements and creating inefficiencies. These overreactions can be driven by emotions or cognitive biases, leading to mispricing of assets and potential opportunities for astute investors who can exploit these market inefficiencies. The presence of others can increase risk. Taking behavior. This quote suggests that individuals risk. Taking behavior can be influenced by the presence of others. In a social context, people may be more inclined to take on higher risks, driven by a desire to conform, gain social approval, or follow the crowd. Recognizing the influence of social dynamics is essential when making investment decisions to avoid irrational behavior driven by group mentality. Confirmation bias leads investors to seek information that supports their existing beliefs. This quote refers to confirmation bias, where individuals tend to seek and interpret information in a way that confirms their existing beliefs or biases. In finance, this can lead investors to overlook or dismiss information that challenges their preconceived notions, potentially hindering objective analysis and decision-making. The best investors are not necessarily the ones with the highest IQ, but those who are more rational and disciplined. This quote emphasizes that successful investing is not solely determined by intelligence. Rationality, discipline, and an understanding of behavioral biases play crucial roles in making sound investment decisions. Being aware of psychological factors and maintaining a disciplined approach can be more important than sheer intellectual capabilities in achieving long-term investment success. Forecasting future market movements is a futile exercise. This quote expresses the idea that accurately predicting future market movements is extremely difficult. Market dynamics are influenced by numerous factors and are inherently unpredictable. Investors should be cautious of relying too heavily on forecasts and instead focus on diversification and long-term investment strategies that can withstand market uncertainties. The best investment strategy is one that aligns with your risk tolerance and financial goals. This quote emphasizes the importance of individualized investment strategies. Each investor has unique risk tolerance levels and financial objectives. A successful investment approach should be tailored to these factors and strike a balance between risk and return that aligns with one's personal circumstances and objectives. Past performance is not indicative of future results. This quote is a reminder that historical investment performance does not guarantee future success. While past performance can provide insights, investment decisions should not be solely based on it. Other factors, such as market conditions, economic trends, and individual circumstances, should also be considered when evaluating potential investments. Fear and greed are powerful drivers of market behavior. This quote highlights the significant influence of emotions, specifically fear and greed, on market behavior. During times of market volatility, fear can lead to panic selling, while greed can drive irrational exuberance and asset bubbles. Recognizing and managing these emotions is crucial for making rational investment decisions and avoiding costly mistakes. Don't invest in something you don't understand. This quote emphasizes the importance of understanding the investments in which you allocate your capital. Investing in complex financial instruments or strategies without a clear understanding of their underlying mechanics and risks can lead to unexpected losses. Investors should strive for transparency and ensure they have a good grasp of the investments they choose. Time in the market is more important than timing the market. This quote suggests that focusing on long-term investment horizons is generally more fruitful than attempting to time short-term market fluctuations. Trying to predict short-term market movements is challenging and can lead to missed opportunities. Investors who stay committed to their long-term investment plans tend to benefit from the compounding effect of time in the market. Consistency is key in investment decision-making. This quote emphasizes the importance of consistency in investment decision-making. It is crucial to establish a well-defined investment strategy and stick to it, rather than making impulsive changes based on short-term market fluctuations or emotions. Consistency helps maintain discipline and reduces the likelihood of making irrational investment choices. It's better to be approximately right than precisely wrong. This quote highlights the trade-off between precision and accuracy in financial decision-making. While precision may seem desirable, it is often unattainable due to the complexity and uncertainties of the financial markets. It is more prudent to focus on making informed approximations and reasonable estimates, rather than striving for an unattainable level of precision. Don't let sunk costs influence investment decisions. This quote cautions against letting sunk costs, which are expenses that have already been incurred and cannot be recovered, influence investment decisions. An investment should be evaluated based on its current and future prospects, rather than being influenced by the desire to recoup past losses or justify previous decisions. Rationally assessing investments can prevent the perpetuation of poor choices. Market prices reflect the consensus of market participants, not objective reality. This quote highlights that market prices are determined by the collective actions and beliefs of market participants, which can be influenced by various biases, emotions, and limited information. Market prices may deviate from objective reality, creating opportunities for astute investors who can identify mispriced assets or exploit market inefficiencies.